Let's take a look at how the government and the big banks are quietly, systematically, and legally robbing you of your wealth. It's a number. Just a simple, innocent-looking number, 2. Specifically, 2% inflation. If you've ever half-listened to a financial news report while trying to figure out if you have enough clean socks to get through the week, you'll know central banks aim for 2%. They sell it as a noble, stable goal. Maybe in macroeconomics it is. But for your actual money in your actual account, it's a termite silently chewing your financial foundation and stilling your buying power. So, what is 2% inflation? It means, on average, stuff gets 2% more expensive every year. Coffee, $5 today, $5.10 next year. 10 cents? You probably have that stuck to old gum in your bag. That 10 cents is the first drop that becomes a flood. A tiny price hike starts a long, slow con. And the mark, I'm sorry to say, is you. Imagine a crisp $100 bill. You feel good about it. It buys a slightly disappointing cart of groceries. At 2% inflation, next year that cart costs $102. The $100 hasn't changed, it still looks the same, but its power is fading. It's a superhero losing 2% strength each year. First, Superman. Decades later, a guy in tights who can't open a jar. We're taught to save. Put it in a bank. Be responsible, like eating vegetables. But what if the veggies slowly lost their nutrition? That's your savings. You're doing the right thing saving, but the system punishes savers. 2% is a policy choice, not natural law. It hits everyone except Wall Street wizards or dragons hoarding a mountain of gold. For the rest of us normal humans, it's a slow-motion heist. Now let's get into the truly depressing math. I promise to make this as painless as possible. The real villain here isn't just inflation, it's compound inflation. It's the evil twin of compound interest. You know how financial gurus tell you to invest early to harness the magic of compounding? Well, inflation has its own dark magic. It works the exact same way only. In reverse. It's not just prices go up 2% of the original price each year. No, that would be too simple. They go up 2% of last year's higher price. It's a snowball, rolling downhill and flattening your purchasing power. Let's use that $100 item again. Small numbers are less scary. After 1 year at 2% inflation, $100 becomes $102. Year 2, 2% of $102, another $2.04, now $104.04. See? It's getting messy. Over time, this sneaky process adds up. Formula, price times 1.02 per years. You don't need to memorize it, you need to see it. After 10 years, about $122. After 20 years, nearly $149. After 35 years, a typical career, over $200. It has literally doubled in price. If you saved $100 and hid it under your mattress 35 years ago, today it buys less than half of what it did then. You lost half your money's power without spending a dime. This is reality for every dollar not growing faster than inflation. Your money is on a treadmill. Speed set to 2%. Standing still or walking at 1% in a savings account means you're moving backward. You are getting poorer, 1 year at a time. It's like trying to walk up a down escalator. It's exhausting. You end up where you started, with less dignity. Recap. Your money's value is not static. It's decaying. The 2% inflation target ensures a steady, predictable rate of decay. It's like a product with a built-in expiration date. The product is all your money. The institutions telling you to save are often the ones setting the rules that make saving a losing game. Like a casino owner saying, "Play the slots to get rich," they know the house always wins. In this casino, the house is the economic system. That 2% is the house edge. So who gets hit the hardest by this whole scheme? Well, let's start with the most responsible, sensible, utterly screwed: the savers. These are the people who do exactly what they're told. They work hard. They spend less than they earn. They dutifully put the rest into a savings account. They check their balance. The number goes up by a tiny amount each month, thanks to the miracle of interest. It feels good. It feels like progress. But it's a complete and total illusion. Like thinking a toupee looks like real hair. The interest rate on a typical savings account is, to put it mildly, pathetic. In today's world, you'd be lucky to find a standard savings account paying even 1% interest. Let's do the math, and I apologize in advance for crushing your spirit. Inflation humming at 2%. Bank gives you 1%. You are losing 1% of your money's value every year. You are paying the bank for the privilege of them using your money. Your savings account is not a safe. It's a leaky bucket. Imagine you have $10,000 tucked away for an emergency. You put it in a savings account that earns 1% annually. After a year, your statement shows $10,100. Hooray! You made $100. But over that same year, prices went up 2%. To have the same purchasing power you started with, you'd need $10,200. You are, in real terms, $100 poorer. Your money had a baby, but the cost of raising that baby went up so much you ended up in debt. It's a fundamentally broken system for anyone trying to build wealth slowly and safely. This is the saver's dilemma. To be safe, you put your money in the bank. But that safety guarantees you will lose purchasing power over time. You must choose the certainty of losing a little every year to inflation, or take the risk of investing in things like the stock market. It's like being told you can either be eaten by a crocodile slowly or try to fight a shark. Neither option feels great, does it? The system is essentially punishing you for being cautious. If savers are on a treadmill to nowhere, then retirees on a fixed income are on a conveyor belt headed directly into a furnace. There is perhaps no group more vulnerable to the slow, grinding cruelty of 2% inflation than those who are no longer working and are relying on a set amount of money each month. This includes people with private pensions that don't adjust for inflation, people living off the proceeds of their life savings. For them, inflation isn't a theoretical concept. It's a direct year-after-year pay cut that they can do absolutely nothing about. It's a monster that gets hungrier every year. Think about a retired teacher. Let's call her Linda. Linda retired 10 years ago with a pension that pays her a fixed $3,000 a month. She could pay her mortgage, buy groceries, see her grandkids, afford a yearly trip to a slightly warmer state. But for the last decade, her income has stayed frozen at $3,000, while the cost of everything else has been creeping up by 2% annually. That trip to the grocery store costs more, her property taxes are higher, the gas for her car is more expensive. Every single year, her fixed income buys a little bit less. After 10 years of 2% inflation, prices have risen by about 22%. This means Linda's $3,000 pension now only has the purchasing power of about $2,460 from when she first retired. That is a massive, life-altering cut to her real income. The trip to see the grandkids might now be a phone call. The slightly warmer state is now just turning up the thermostat and pretending. This isn't because she mismanaged her money or made bad choices. It's because the system she is living in is designed to devalue her income over time. She is being punished for the simple act of getting older. This is a quiet crisis unfolding across the country. Millions of seniors planned their retirement based on the dollar amounts they were promised, without fully accounting for this silent thief. They saved enough money to generate what they thought would be a stable income for the rest of their lives. But that stability is a mirage. A fixed income is only fixed in number. Its actual value is in a constant state of decline. It is a promise that is being broken in slow motion, and it leaves the most vulnerable members of our society facing an impossible choice between cutting back on essentials or running out of money entirely. So, if savers and retirees are getting the short end of the stick, someone must be getting the long end, right? Money doesn't just disappear into thin air. Well, its value does, but the money itself goes somewhere. So who are the winners in this rigged game? The answer is people and institutions with massive amounts of debt, and also those who own the assets that inflate in price. In other words, governments, large corporations, the already wealthy who make the system work for them. Let's start with the biggest winner of all, anyone with a lot of debt. Who has more debt than anyone else? Yes, the government. When there's inflation, the value of the money you owe goes down over time. Let's say the government borrows $1 trillion today. In 30 years with 2% inflation, that trillion will have shrunk by nearly half. They still have to pay it back, but with future, less valuable dollars. Like borrowing $20 and paying back a crumpled 20 that only buys a gumball. Inflation is the government's get-out-of-jail-free card for borrowing. Don't worry, a rising tide lifts all boats, especially my yacht. Next up, investors. While your savings account earns a laughable 1%, these folks buy assets that grow faster than inflation. Stock market, real estate, commodities. If stocks return 7% and inflation is 2%, the real return is 5%. They beat inflation. They get richer in real terms while the saver gets poorer. The rich get richer, the cautious get screwed. This creates a dangerous cycle. Saving is a losing game, so those with money and know-how are pushed into investing. That drives up prices of stocks and houses, mainly benefiting current owners. Meanwhile, someone who can only save a few $100s is left behind. A system that rewards risk and ownership over caution and labor. It actively transfers wealth from the conservative saver to the aggressive investor and to the indebted government. And they call it a stable economy. So why this specific number? Why 2%? Why not 0? Why not 5? Why not 42? It sounds so arbitrary. But there is a logic to it, even if it mostly serves the system. Central banks, like the Federal Reserve, have a few key reasons, and none of them involve making sure your grandma can afford her medication. Take a second and hit that like and subscribe. First, they fear deflation. Deflation is when prices fall. That might sound great, cheaper stuff for everyone. But economists say it can be catastrophic. If people think prices will be lower tomorrow, they might delay purchases. Why buy a car today if it's cheaper next month? Consumer spending can grind to a halt. Companies may cut production, companies may lay off workers, and that can trigger a downward economic spiral. A little inflation acts as a buffer. It keeps the economy from the deflationary abyss. It greases the wheels of the economy, they say. Second, inflation helps wages and prices adjust. In a perfect world, a company might cut what it pays its workers. But people hate seeing smaller paychecks. Not getting a raise when inflation is 2% is effectively a 2% pay cut. It's a stealth wage reduction to keep labor costs flexible. Less painful, but still a pay cut. Finally, a predictable inflation target is a policy tool. When the economy is weak, central banks can lower interest rates. Lower rates encourage borrowing. Lower rates encourage spending. Positive inflation gives room to cut rates before hitting 0. It's part of their toolkit for steering the national economy. 2% is the Goldilocks number, not too hot, not too cold. But what's good for the system can be devastating for individuals. Their goal is systemic stability, not your personal prosperity. To see how this all plays out in the real world, let's tell a story. It's the story of Maria, a diligent 60-year-old who has spent her life working and saving. She's done everything right according to the old rules. She now has a nest egg of $200,000, which she keeps in a combination of a bank savings account and some very safe certificates of deposit, or CDs. On average, her money is earning about 1% interest per year. She looks at her statements, sees that she's making $2,000 a year in interest, and feels secure. She plans to retire in a few years and live off this money. But Maria's sense of security is built on a foundation of sand. The 2% inflation beast is lurking, and it's about to eat her retirement for lunch. With her savings earning 1% and inflation running at 2%, the real value of her $200,000 is shrinking by 1% every single year. At age 60, her nest egg can buy her $200,000 worth of goods and services. But by the time she's 70, after a decade of this slow erosion, her savings, which will have grown to about $220,900 on paper, will only have the purchasing power of roughly $181,000 in today's money. She has lost nearly 10% of her life savings just by trying to keep it safe. Now, let's imagine an alternate reality for Maria. What if, at age 60, a friend had explained this whole inflation scam to her? Instead of keeping all her money in the bank, this alternate universe Maria decides to take on a bit of calculated risk. She keeps an emergency fund in cash but puts the rest, say $180,000, into a diversified low-cost investment portfolio stocks bonds that earns an average of 6% per year. This isn't some get-rich-quick scheme. It's a standard long-term investment strategy. After the same 10 years, her investment would have grown to over $322,000. Now let's factor in inflation. After accounting for that same 2% annual price increase, her nest egg's purchasing power would be around $264,000 in today's money. Compare that to the first Maria, whose nest egg is worth only $181,000. That's a difference of over $80,000 in real-world buying power. One Maria is facing a retirement of cutting back and worrying about every dollar. The other Maria has a comfortable cushion, all because she understood that safety in a savings account is an illusion. It's a stark choice between watching your money wither or helping it grow. Words and numbers can only do so much. Sometimes, to truly understand the sheer slow-motion horror of what we're talking about, you need to see it. You need a picture. So, let's imagine a chart. It tracks the journey of $10,000 over 30 years. This isn't just a chart, it's a crystal ball showing 3 possible futures for your money. It's the kind of thing that should be printed on the back of every dollar bill as a warning label. This is the chart that screams the truth about 2% inflation. The first line on our chart is the saddest. Let's call it the mattress. This line represents $10,000 in cash, earning 0% interest. For 30 years, this line is completely flat. It starts at $10,000 and ends at $10,000. It looks stable. It looks safe. But this is a lie. Because while this line stays flat, another line is on the move. That second line is the cost of living. It starts at $10,000 and climbs relentlessly upward at a 2% angle. After 30 years, that line is sitting at $18,113. The gap between these two lines is the ghost of your lost purchasing power. Your flatline $10,000 can now only buy what about $5,520 could have 30 years ago. You've lost almost half your money. Now let's add a third line, the savings account. This line represents your $10,000 earning a steady 1% per year. It's not flat. It curves gently upward. After 30 years, your $10,000 has become $13,478. You feel a flicker of pride. You made money. But then you look at the cost of living line, still sitting smugly up at $18,113. Your savings account didn't even come close to keeping up. You lost the race, badly. You're still significantly poorer in real terms. Finally, we add the fourth and final line, the investment. This represents your $10,000 in a balanced portfolio earning an average of 6% a year. This line doesn't just climb, it soars. After 30 years, it reaches a staggering $57,435. It has left the cost of living line in the dust. This chart makes the abstract concrete. It shows that saving money in a low-interest account is not a neutral act. It is a decision to lose. The visual gap between the savings line and the cost of living line is the price you pay for perceived safety. It's the quiet tax on financial caution. Looking at this chart, you realize the only way to win, or even to just not lose, is to have your money working for you in a way that outpaces the system designed to devalue it. That screaming you hear? It's your future self begging you to pay attention to this chart. Okay, so the system is rigged, saving is for suckers, your money is melting like an ice cream cone on a hot day. It's all very depressing. You might be tempted to just give up, buy a llama, and move to a remote cabin in the woods. And while I fully support the llama part of that plan, giving up is not the answer. The good news is that once you understand the con, you can start to fight back. You don't need to be a Wall Street genius or have a secret password. You just need to take a few simple, concrete steps to move from being a victim of inflation to someone who can navigate it. First, you need to know your enemy. Go look at the interest rate on your savings account right now. I'll wait. If that number is lower than the current rate of inflation, you are losing money. Your first mission is to find a better home for your cash, especially your long-term savings. High-yield savings accounts exist. They might not fully beat inflation, but they'll get you closer. For your emergency fund, the money you need to access quickly. This is a good first step. It's about minimizing the damage. Think of it as upgrading from a leaky bucket to a slightly less leaky bucket. Second, start thinking like an investor, not just a saver. I know, the word investing can be scary. It brings to mind people in suits yelling at screens. But for most people, it can be much simpler. A great place to start is with low-cost diversified index funds ETFs. These funds hold a tiny piece of hundreds or thousands of companies, so you're not betting on just one. Over the long term, broad market index funds have historically delivered returns that outpace 2% inflation. It's the simplest way to get on the right side of the wealth-building equation. Finally, bake inflation into all your future planning. Don't pull a retirement number out of thin air. Use an inflation calculator to see what today's income will cost in 20 or 30 years. That $50,000 a year retirement you're dreaming of will cost over $90,000 in 30 years with 2% inflation. Knowing that changes everything. It forces you to be realistic. Don't let the silent poison of inflation derail your future. The 2% lie is only powerful if you don't know it's a lie. Now you do. So go out there and fight for your financial future. And maybe get that llama. You've earned it. Thanks for watching. Please like and subscribe. It will help us grow and reach more people.